Welcome to Momentum Monday. Today it's February 13th, 2022. Howard, did you make any bets on Super Bowl?
No, I don't gamble. I really am kind of a boring, kind of like you in many ways, even though it's like a older, thinner, less hair version of you.
I wish. Looking at your picture behind you, it kind of looked like
yeah, it looks like the market, that black
a map
spot.
of the S&P 500.
Yeah, that's the S&P 500. There's no green. It's just black for oil. Those are the oil stocks that are black, but they're green on your screen, but in my screen they're black. So walk us through this this tape, what you're seeing.
Okay. Basically, what I'm seeing is this weakness in tech. Here's the Nasdaq 100. As you can see, tried to rally towards this flat 200-day, and then it was rejected. So the CPI readings came out on, when was it, Thursday, a little bit above expectations. That basically kind of started that pullback. What was interesting to me is that on Thursday, after, there was an initial gap down, then a recovery, then another sell-off. What was interesting is that many of those software names that were down 50 to 70% in the past 3 months, they kind of held really well on Thursday. Friday, obviously, the picture was completely different, especially after the Russia-Ukraine news came out.
Yeah.
But at some point on Thursday, I was thinking that maybe the narrative has changed for those high risky assets like biotech and software, because many of them are down so much that maybe the market has already discounted like 100 or 200 basis points interest rate increase. But correlations went to 1 again on Friday after that Russian news came out. And as you can see, tech definitely the weakest. And in the meantime, anything commodity related, especially oil and gas, is just breaking out, making new highs. Here's XOE. I think that's like new, I don't know, 52-week high maybe. Like if you look at the 52-week high list, the new 50-day high list, it's all about commodities. It's like 70% oil. Then you have some fertilizers, some metal stocks, but just mostly commodities. So in general, that's kind of what summarizes the current market. Is kind of bifurcated market with commodities strong and anything else. And after that, banks are kind of neutral, I would say, and then anything else has been really weak year to date. And as you can see as my background, I have the S&P 500 stocks with their year-to-date performance. So you have that tiny little green spot, which is energy, and then also banks are kind of green. Everything else, as you can see, super red.
Yeah, so it's one of those markets. If you're like a growth investor, you just pick up the phone and do sales calls. The tech people, the Facebook pullback, basically there's one company dominating, and then it's Apple, and Google look good, but it's I think it's going down into that gap, the earnings gap. So there's just no reason to get excited about tech. The price momentum's gone. It's been gone for a while. You've got an administration that's focused on battling inflation. That's not going to be good for growth stocks, because they got to bring up interest rates. It just is what it is. You can talk about these things being down 50%, but they were all up thousands of percent. And the FANG stocks, other than Apple, are all broken. Apple and Google. So you got Facebook beaten. So and then you add a brain drain where all the young people can go to crypto and get paid in crypto and talk on chat rooms all the time and work remotely and trade 24/7. They don't need growth stocks. So you could see a whole new generation just kind of getting by without the stock market, that won't last forever, because eventually, they get the rates to a point where the Fed can start, but that can take a while. And during that while, commodities, while they don't interest me, it's a huge market.
That's what's trending. Yeah, right now.
Yeah, huge market. And they have so much leverage because they're not going to drill. No, the government here is not going to let anybody drill more. So you've got like supply constraints, OPEC, oligopoly, and no one can dig or get new oil. So what's beyond this next energy craze is a lot of technology and carbon neutral stuff. But man, that could take 5 years. So, this energy run could surprise a lot of people. If I understood it other than just from price trends, I'd be interested in it. But, I don't need to make a living off the stock market. And for those people that do, preservation of capital is important, even if it takes a couple of years for them to go through this interest rate cycle. And get the Fed back in a position where they can be accommodative, not restrictive. It's going to be a brutal battle politically. You can feel it. The Dems can't get anything done. So, I think the short sellers now have a great place to short stocks against, right? Like Datadog's highs, Cloudflare's highs, post-earning. You have all these great places for short sellers to lean against, and you've got all these great downtrends for hedge funds to make a living shorting growth stocks. So I don't have enough capital to make them to be the bottom for these things. So energy is the trade, but you have to understand these are cyclical kind of things with high leverage.
Most stocks are cyclical, Howard. There are very few that will really continue to grow for decades.
Well, stocks were cyclical, but non-cyclical, but they got so over-owned because people just thought they could continue to grow at crazy multiples. So they've got to come down to who are we to say when the valuations get back to where real money wants to own these things. So we're in a revaluation period for these technology stocks. And, Apple's in a separate world of its own because it basically has a monopoly. And it has massive cash flow and incredible margins. And everybody needs their product. Google keeps them honest in some way, but Facebook can't keep them honest. They control Facebook basically based on Facebook's earnings. Netflix continually has to spend to create new content to keep their churn down. So there's a very few companies that really in a tough growth market that can succeed. So looks like the energy and commodity cycle is in swing, and for those that can just trade price,
yeah.
Are you trading energy?
Oh yeah, absolutely.
Okay.
Basically that's the only thing I'm long right now, and also some fertilizers.
Like people that have to make a living and you only have to have 4 or 5 position in swing trades. It's just a ticker to you.
You have to adjust to whatever the market currently offers. If you remember that period in the mid 2000s when commodities were super strong again, obviously that was like China related, as China was growing. But at the time, the difference was that at the time, obviously interest rates were a lot higher than they are today. But we also had some non-cyclical stocks like Crocs and like Apple that were making all-time highs alongside the commodities. So it was a lot more better diversified market in terms of names on the 52-week high list.
Yeah, those markets though didn't have inflation, and the government wasn't as completely fucked up as it is now. And
there was inflation in the mid to late 2000 that what basically led to the housing boom and then to the crash. And as you can see here, after 2006 to 2008, many of those commodities, I mean, they went up, like some of them went up 1,000%.
Yeah.
So yeah, something to keep in mind. It can last a couple of years. It's not something that.
No, it can last a long time. And who's to say this cycle isn't longer than the last cycle, right? Because you can't make more of this stuff, and the government's not allowing people to drill and dig. And the technology for nuclear, I mean, we don't really have a nuclear plan, and we're still years and years away from like the technology. And listening to a bunch of biotech people, we're years and years and battery people, we're years and years still away from like, the renewable stuff really being mainstream and fusion and stuff like that. So it's a tough quarter. Listen, we'll see. Like, these things can bottom, but right now the downtrend is such that people have to learn to some new tickers. And
yeah, definitely. I mean, tech was so favorable to so many people, just holding tech companies for the past 10 years, not even trading them.
Yeah.
And
10 years out, it could still be favorable, and this could just be a couple years sideways down. But I generally, when so much brain power is moving to crypto, and so much money has been invested in VR and hardware that may not be of interest to as many people as they think. So and right now crypto is mostly just about trading, so it's not very productive. So it can't support. There's just not enough. I like stuff to do right now in crypto. So basically, you just got this incredible amount of supply of technology and growth, paper and stock. And even though the companies are great, we're in a valuation contraction period. So
but the biggest and the fastest growing crypto companies actually publicly traded. So maybe we'll see more of those, which to me is a very interesting trend, because instead of them just issuing their own crypto coins and just trading on a forex exchange, like they don't want to do that. They just want to be like the platform and the infrastructure, and they just want to offer their shares. So that would be one way to participate in that, let's call it Nasdaq 2.0.
Who are you talking about? Coinbase?
Yeah, Coinbase and all the big crypto companies like OpenSea and others. Maybe they also become publicly traded.
Yeah, right now those are just platforms for listing things, and they're basically commodities. Coinbase has somewhat of a moat in trust and scalability, but like OpenSea will have hundreds of competitors, including Coinbase. So it's not determined yet how big that market is. It's a fraction. The whole crypto market is a fraction of what Apple is. So we're still talking about a tiny part of the technology ecosystem. And I think we're just in a period where there's just really a lot of supply, some unproven business models, and just textbook valuation contraction from the rising interest rate environment. But I think following guys like you who are ticker agnostic and risk management focused is, if you want to be a professional in investing, you have to go path of least resistance, or have investors that are patient enough that they can wait 2 years with underperforming returns. We've seen this happen in many categories. Biotech for the last 2 years have been weak, and this is just the way the markets work. Anyways, for me, it's just go work on other projects. You can't change the markets yourselves. So I mean, anything else?
I mean, as I said, on the long side, the only thing that's working is commodity related. Some of the metals, like on Friday, it was interesting to me that after the like we know that the treasuries was already breaking down, and then after the Russian news, came out, obviously treasuries are considered the safe haven. So treasuries rallied, interest rate pulled back. So if that things escalates, we might see actually interest rates reversing lower. So I'll call that.
Yeah, the market really starts to correct. Rates could get driven down again, but I don't think that on its own changes, the trend for growth stock. So you'll see some vicious bounces. I think tech's in a bear market period.
Yeah, definitely the bounces are getting sold off. As you can see, many of those software as a service names, they kind of rallied to their declining 50-day moving average. It was a pretty significant rally for most of them, 20-30%, and now they're pulling back. So they keep making lower highs, making lower lows. That's a definition of a downtrend. Super highly correlated also with the Nasdaq 100. So like here right now, I'm watching that, I would say like 330, 333 level. I think if it's lost, we might see a drop all the way to 320, even 300. Yeah. Basically.
Which still is about a 25%.
Yeah, 23, 4% drawdown. Considering that huge move should not be such a big surprise. Obviously, it's not going to feel well if you're fully invested in software names, but you have to hedge if you don't have an exit strategy and willing to sell.
About this since December. If you're in growth, and you're on margin, or you're 100% invested, you don't know what you're doing, because this is a lot of positions. Even if you're loose like me and gave some of your big winners over the years room, you've been stopped out, whether it was Peloton or Spotify.
So if the Nasdaq 100 really drops 20 to 25%, which are the three stocks that you would be buying on such a pullback?
Well, again, right now the Nasdaq, it's don't know, because a lot of these, I'd have to see relatively what's holding up better, because for me it's relative strength. Once the market gets really weak, I'm looking for different areas, and so I just don't know.
So you're not thinking in terms of that this business will be
strong. No, everything right now is
5 or 10 years.
Right now, everything's for sale, in my opinion. It's just like the price action is the price action. The companies have to continue to execute. I'm trying to pick the biggest markets so I don't go, so I stay invested and I don't time the market. But, cash levels at 40, 50% for what I have invested in stocks is a high cash position. And, on a very low end, maybe would get down to 40% invested for my stock portfolio. But there's not a position where I want to be long energy. But I understand it's been a year where people have been bragging about being energy allocated. But even if you're a general asset allocator, 10% to energy and commodities, so you're up 20% this year. So it would have added 2 basis points this year after adding nothing for 5-6 years. So, for all those people, blahing about, exposure to energy, even if you were like a rational, complete asset allocation person, this year adds a couple basis points to your whole portfolio for all the drag it's cost over the last 5, 6, 7 years. Big deal. So I think the most important thing for people that watch this show is, you preserve money, you preserve capital in a bear market, and that's so that eventually bull markets return. I assume tech's so big that it's not going to be the same tech stocks, but growth is growth, and digital and tech is where the growth is. And eventually in energy, it'll be the same thing. It'll come from tech and innovation. It won't come from behemoths like Exxon. They'll deploy the tech, but they won't be the ones creating the tech, because it's not in their interest. It won't move the needle for them. And it'll show up in the charts. Right now, like you said, probably the IBD lists and the stocks, all the momentum lists have energy and regional financials in them. And those just aren't typical growth companies. And if the market rolls over, that'll roll over too.
Yeah, most of them, yeah. Commodities might actually, you know, have a bit, but we'll see.
Yeah, gold's got a bid, and it should, right? Like the dollar, if the dollar gets weak, gold will go up. But that should also be good for a couple of the crypto companies like Bitcoin and Ethereum, platforms like Bitcoin and Ethereum. So anyway, it's just 1 week, and not much has changed other than, like you said, it's just, you know, the tech stocks that rally got sold off again really hard. And we'll check back next week. But have a great week, buddy.
All right, you too, Howard.
All right, everybody.